You've probably never heard of Amphenol. Yet over the last decade, it has quietly outperformed most of the stock market, up 950%. Today it's becoming one of the biggest hidden beneficiaries of the AI boom. So here's the question: has the market already priced in that opportunity, or is Amphenol still flying under the radar? Morningstar rates Amphenol a wide moat, built on two sources: switching costs and intangible assets. Amphenol makes connectors and sensors for mission-critical systems. Think EV battery management, fighter jet avionics, AI data center infrastructure, and power grids. These aren't consumer gadgets. If a connector fails in your smartphone, you buy a new phone. If a connector fails in an aircraft or a power grid, the results can be catastrophic. That changes everything about how customers make decisions. They don't switch suppliers to save a few percent on cost. They stick with the partner they trust completely. Amphenol embeds engineering teams directly on-site at customers, co-designing systems from the ground up. By the time a product ships, switching away means a full redesign, retesting, and months of production risk. The intangible asset moat comes from engineering depth. Around 25% of Amphenol's annual sales come from products released in the last 2 years. This is a company that reinvents itself constantly, not to chase trends, but to stay one step ahead of commoditization. The one real risk worth flagging is nearly a third of revenue comes from China. Any escalation in US-China trade restrictions is a genuine headwind, but the moat is real and it's wide. Every data point in this video comes from Fiscal.ai, the platform I use for every analysis on this channel. Link in the description for 15% off. Returns on capital tell us how efficiently management converts invested dollars into real profits. And this is where Amphenol truly separates itself. Amphenol's return on invested capital is 26.6%, the highest in the peer group and trending upward. TE Connectivity comes in at 9.9% and Belden at 11.7%, both essentially flat. On return on equity, the gap is even wider. Amphenol at 36.9% compared to Belden at 18.6% and TE Connectivity at 14.5%. This is a business that generates more profit per dollar invested than its competitors, and that gap is widening. But returns are only half the story. Sustaining them while growing is much harder. Growth is where Amphenol separates itself from the pack. Over the last decade, revenue has grown at a compounded annual growth rate of 15.6%, net income at 20%, and earnings per share has grown at a 19.9% CAGR. Let's compare this to peers. Belden comes in at 9.3% and TE Connectivity at just 1.4%. Amphenol isn't just winning, it's in a different league. Now look forward. Analysts expect Amphenol's earnings per share to grow at a CAGR of 23.8% through 2028, rising from $3.3 to $6.3 per share. That's driven primarily by one thing: AI infrastructure. Amphenol's data center revenues nearly doubled year over year in the most recent quarter. Its connectors are embedded in Nvidia's Blackwell and Rubin server platforms, the backbone of the AI build-out. But here's what makes Amphenol structurally different from a pure AI play. No single end market accounts for more than 25% of sales. Defense, industrial, automotive, mobile networks are all growing. When one market slows, another carries it. That diversification is rare and it's deliberate. The AI tailwind is real. The diversification acts as a floor. That combination is why the growth profile here is so compelling. Now, does the balance sheet support it? Let's find out. Financial strength is our sleep at night factor. And with Amphenol, the picture is solid but worth examining closely. Total cash and cash equivalents stands at $11.4 billion against total debt of $15.5 billion. That debt load has grown significantly, up $8.6 billion compared to last year, mainly driven by Amphenol's $10.5 billion acquisition of CommScope's connectivity business, its largest deal ever. Context matters here. Free cash flow is $4.4 billion, giving a free cash flow to total debt ratio of 28.4%, where 10% is the bare minimum. Amphenol is well above it and can pay off its entire debt load in just under 4 years. Over the past decade, Amphenol has acquired more than 40 companies and consistently brought each one up to firm-wide profitability, in some cases within 6 months of closing. The CommScope deal fits that pattern. Management has already guided to a net leverage ratio below 2 by the end of 2026 and rapid deleveraging thereafter. This is leverage that is deliberate, not distressed. But the debt load is real, it is elevated, and is something to watch as the integration progresses. Even the best business can be a poor investment if you overpay. So let's put a number on it. Amphenol trades at a forward price to earnings of 30.6. In historical context, the decade low was 19.1, the median was 27.1, and the maximum was 39.4. So the current valuation sits slightly above its historical median, not extreme, but not cheap either. Against peers, Amphenol trades at a clear premium. TE Connectivity at 17.6 times and Belden at 13.6 times earnings. That premium has been justified by superior growth and returns, but it is a premium. Now let's bring in the price to earnings growth ratio because PE alone ignores long-term growth. With a forward PE of 30.6 divided by a long-term earnings per share growth estimate of 16.5%, that gives a PAG ratio of 1.85. A PAG ratio below 1 points to undervaluation, between 1 and 1.5 is fair for a quality compounder, and above 1.5 is expensive. The PAG ratio of 1.85 is the honest summary. The growth is real, the moat is wide, and Amphenol has a consistent history of beating guidance. The most recent quarter by more than 10%. If that continues, today's valuation may look reasonable in hindsight. But at a PAG ratio of 1.85 with an elevated debt load, the margin of safety is thin. This is a quality business, but quality at the right price is a different conversation than quality at any price. Let's bring it all together through our 5 key factors. Amphenol's moat is wide, built on switching costs in mission-critical applications and deep engineering intangibles. Returns on capital are best in class, with a 26.6% return on invested capital trending upward with peers not even coming close. Growth is exceptional with a 23.8% projected earnings per share CAGR through 2028, driven by AI infrastructure and a uniquely diversified end market. Financial strength is solid with a flag. $4.4 billion in free cash flow, but that is elevated after the CommScope acquisition. Valuation is premium with a thin margin of safety. A PAG ratio of 1.85 on an elevated debt load leaves little room for error. A quality business, but only compelling if AI infrastructure spending continues to surprise to the upside. Let me know what you think in the comments. And if you found this analysis useful, like and subscribe for weekly stock analysis videos.